House prices are going to fall 10%. Well, that's what some commentators are saying. On the other hand, Dr. Andrew Wilson, Australia's leading housing economist, says that's nonsense. Now, why does he say that? Well, in today's Property Insider video, we're going to give you some evidence explaining what's happened in the past and why we don't believe property values are going to crash anytime soon. We're also going to talk about what's happening in the last weeks of our property market for 2021 and the auction results. If you want to keep up to date with what's happening in our markets, why not subscribe to this YouTube channel and click the little bell icon so you know when our next show comes out. If you're watching the news or reading the financial media online, you couldn't miss the forecasts of property price falls ahead. And it's no longer only the perpetual property pessimists, those who've been getting it wrong time after time. It's not only them who are suggesting this, it's now the regular media commentators and the bank economists. Now, of course, they don't all agree. Some are suggesting that prices will fall modestly as the cycle slows down. Some think falls will happen next year, while others believe they're going to occur in 2023 after a strong year of property price growth next year. Now, the ANZ Bank has been forecasting modest price falls of around 4% in 2023, while the CBA are suggesting prices could fall up to 10% in 2023. Really? So are they right? Is it too late to buy in this current cycle? Should we worry about the value of our homes plummeting? These are some of the questions I'm going to be asking Dr. Andrew Wilson, Australia's leading housing market economist and chief economist of My Housing Market, in this week's Property Insider Chat. Hi, Andrew.
Good morning, Michael, and it is the end of the year season to be not jolly, but doom and gloom. So what's the opposite to jolly? To be miserable. And we've got all those forecasters fueling the misery of the nonsense of sharp falls in house prices in 2023.
Well, housing markets generally have recorded extraordinary price growth this year, and we know it's been driven by low interest rates and a rebound of demand, reflecting the interruptions to the activity we've had over the last couple of years. And we know Sydney and Melbourne have led the charge. But price growth, while still strong, seems to have already started moderating. So what is going to happen, Andrew? Are these predictions of 10% or even more falls realistic, or are they just nonsense?
Well, they're nonsense given the historical record, Michael. And if we look back to, I guess, as far back as we can go with reliable statistics, and that's 1987 through the ABS, if we look at the annualised change in house prices or home prices, so that's houses including units, and that's on an annual basis, so it moves from December quarter to the following December quarter, and we look at the growth levels, we can see that the sharpest decline in house prices that we have had in that very long period of time is 5.1%. So the worst that we've had in that period, which is we can use as being reliable from a statistical background, is 5.1%. And that was in 2018, Michael. And of course, what drove that particular downturn was the APRA-initiated credit squeeze directed at investors, where credit was actually withdrawn from particularly investors and interest rates were increased because APRA were concerned that there were too many investors in the market, that they were highly geared, and that APRA were predicting higher interest rates. Well, that prediction didn't pan out terribly accurately, did it, Michael? But of course, the Reserve Bank was predicting the same thing, and they got it wrong as well, big time. In fact, interest rates were cut to the bone following that credit squeeze environment. And but the worst that we got out of that was 5.1%. But if we go back to the other 2 years where we've seen declines, so 3 declines in annual home prices since 1987. If we go back to 2008, prices fell by 4%, and that followed a period of strong increases in interest rates to take the heat out of what was a spectacular mining boom at the time. But interest rates increased over an 18-month period, and the only result we got there was a 4% fall. Similarly, in 2011, we had a 4.1% fall. Again, it followed a significant and sustained period of higher interest rates. So we can see the relationship: higher interest rates, lower house prices. But the two real higher interest rates, lower house price environments, which was 2008, 2011, we saw the worst was 4.1%. So I'm not sure that when we talk about a modest decline of what ANZ are forecasting, if it is around 4%, it's a record decline in house prices. I mean, do these analysts and economists actually do some research and look at the historical record? Do they look at the nature of interest rate increases which pushed down house prices or home prices during that period? We would have to have the mother of all interest rate increases, starting probably at the beginning of next year, to have house prices waning next year at any stage. To forecast a 10% fall over a year, which would be nearly double that of the previous record decline in house prices in our modern history, is just nonsensical from my perspective. And it just begs the question, is there another agenda to these forecasts? We saw similar forecasts made earlier this year by the Commonwealth Bank was one, and we saw as a result of that perhaps a surge in refinancing, in fact, record refinancing, perhaps from consumers concerned that higher interest rates were imminent, and therefore they decided to change their mortgages. But of course, when lockdowns came, those forecasts were all shelved. They were changed using lockdown as the excuse. Perhaps, unfortunately, with it looks like we're maybe confronted with another outbreak of the coronavirus. Fingers crossed it doesn't happen, but certainly that would give these headline-chasing forecasters a reason to backtrack. But I think by early next year, when the data doesn't support their predictions of interest rate increases, and of course that's the background to all these predictions, is they are predicting an earlier than the RBA are telling us, an earlier rise in interest rates, and they're talking about interest rates rising next year. And for that to happen, again, we would have to have the mother of all booms to justify the RBA raising rates, and they would only be justified, as they say, time and time and time again, if we see inflation and incomes rising in a sustained manner between that 2 and 3% target band that they use as a background for higher interest rates. We just don't have anything like that at the moment, anywhere close to that in terms of a sustained inflationary and incomes outbreak. And yet these economists, commentators, continue to predict higher rates next year. It just begs the question, what's it all about, Alfie? What's the agenda here, guys? You can't support it on the data. You can't support it on history, but you keep running with these stories. And of course, the other point, Michael, is what is the point of a forecast if it's changed every 3 months? Look at those forecasts last year. Some were forecasting 20, 30% fall in Australian house prices. We're going to rise by 30% this year in Sydney. So look, good luck to whatever the reason is for these loopy forecasts. But I say to consumers out there, please do your homework. Take this with a grain of salt and don't have knee-jerk reactions on volatile forecasts that change with the wind.
Now, you've been talking about the requirement for wages growth, and that's still subdued at the moment, despite the post-lockdown recovery, and the jobless rate has started to surge again. But we know that recently the government announced a flood of 200,000 migrants or even more set to enter Australia in the short term. This is going to dampen demand for the available jobs at the moment, Andrew, but it's also going to create a requirement for, well, probably rental accommodation. Let's be blunt, these early migrants are not going to be able to buy properties for a while until they get permanent residency.
Well, it's sort of the footnote at the bottom of the doomsayer forecast, is it not, Michael, that, oh, by the way, the government's just announced a surge in 200,000 new migrants into Australia. Now, this isn't going to be the normal growth of migration patterns that we've had. This is actually a real sugar hit to the economy. Bang, extra 200,000. So it will have an impact. Migration levels don't really have a short-term impact. International migration levels don't have a short-term impact on house prices or the housing market, and also the economy. But this is different because this is a surge in migration from 0 to 200,000, and that will create more supply of labour, more demand for jobs, and of course, more demand for housing, whether it be rental accommodation or purchased accommodation. So how does that work into predictions of falling house prices as a result of higher interest rates, as a result of surging incomes? it just doesn't add up, Michael. And as I said, stay tuned. Sooner rather than later, and perhaps the cover will be, sadly, another negative episode through COVID. But get ready for those revised forecasts. And of course, the other forecasters who give us 20 different scenarios, so they can't lose. They've got to get one right. And then when they get it right, they're heralded as being very accurate in terms of forecasting. It's like the punter that goes to the races and bets on every horse and then proclaims he's the greatest punter on earth or she's the greatest punter on earth, because they always pick the winner. But as I said, who cares? It's good for a laugh, but at the end of the day, don't take notice of this stuff, because if you had have taken notice of the doom and gloomers over the obviously the past decade or more, you certainly would have lost out in terms of your financial position regarding the housing market.
Very much so. Don't pay attention to the media, whose job isn't to educate you about property, but to, I guess, get your eyeballs on the ads that they've already sold.
Not the media's fault, Michael. But perhaps they should hold these people to hold them accountable for their mistakes, as well as lauding them for their perceived victories. As I said, even though a lot of them have just given you so many alternatives that they had to get one right.
Now let's turn to the auction markets, because there's only a couple of auction weekends left, and there's been a late flood of spring properties for auction, and that's predictably pushed clearance rates down over the weekend, though generally, Andrew, they still remained in favour of the sellers.
Yeah, absolutely, Michael. We had a remarkable weekend for auction listings last Saturday. Sydney broke the all-time record for the number of auctions conducted on a Saturday. Melbourne had the second highest number of auctions conducted on a November Saturday and the third highest number of auctions ever conducted. It's been a very big month for auction listings. There's two things driving that, Michael. Firstly, we always see higher listings and lower clearance rates at this time of the year. Vendors are keen to get their properties sold before the end of the year, and that pushes supply ahead of demand traditionally as a seasonal factor in November and December. But of course, we've had that added to this year by a wave of post-lockdown vendors that were held back as a result of lockdowns, particularly in Melbourne. So we're seeing that, and of course, those decisions, current auction numbers reflect decisions made about 6 weeks ago. So that was the end of lockdown. So it's been added to these high end of year, typical high numbers have been added to by the revival from those vendors restricted during lockdown. And results, of course, as usual, have pushed downwards. Melbourne's clearance rate was just a tick under 70% at the weekend, but transactions are still occurring at very high levels, Michael. It's just that we don't have a never-ending supply of buyers. And the other point to that is that affordability is starting to push buyers out of the market. We've been saying that, and we've been tracking that for some months. Affordability has been falling. You can't keep borrowing more if your income can't support it to keep up with booming house prices. So that's taking some buyers out of the market. And of course, we've satisfied a lot of that pent-up demand of the previous few years. Buyers don't purchase a home every day or every week, Michael. The typical period for owning a property is 6 years. So we've satisfied a lot of pent-up demand as well. So that means fewer buyers, and that means lower clearance rates. But as I said, still at 70%, as you mentioned, Michael, in Melbourne, is still a seller's market. Make no mistake, still have prices rising. And in Sydney, despite a record day for auctions, we had a higher clearance rate than the week before, over 75%. There's plenty of life left in our housing markets. Prices are still rising. And this is just what we typically see at the end of the year. And the smaller markets also fell away slightly, but they continue to outperform the larger markets. And again, lower clearance rates are a result of very strong end of year listing numbers. We will see listing numbers falling away over the next few weeks to end the year, Michael. And that again is a typical outcome, but it's been a remarkable year this year. And we're ending up with record level sales in Melbourne and Sydney, and certainly a record turnover.
Well, as you say, it's been a remarkable year. There's about a month to go, and I bet lots of people are going to want to conclude their deals, sell their properties, buy new properties, move into their new home for the new year. So it'll be interesting to see what the last statistics for the month come up with. We'll be back each week to discuss this. Look forward to catching up with you next week.
Thank you, Michael.